Okay, we're going to continue Chapter 2, which we started on Monday, the first part of Chapter 2. So just to recap a little bit of the main points. Chapter 2, we started from understanding how to record business transactions. From the beginning, we'll be capturing transactions, meaning the activities happened in the business, in journal. Okay, remember, journal is organized by date. It's a chronological record of all the business activities. Then we'll be posting the same information, just organize it differently. Now we're organizing it by accounts, T accounts specifically, in ledger. Okay, so all the business activities are captured once in journal, then we copy the same information, paste it in the ledger. Ledger is organized by accounts. And remember, accounts represents either a particular type of asset, a particular type of liability, or a particular type of equity. Okay, so accounts represents the changes in a certain type of asset, liability, or equity. So we capture accounts changes in ledger. Ledger is a book of T accounts. So you'll be able to see certain accounts that were involved in a lot of the transactions. Perhaps some of the accounts were not as much affected. Okay, then at the end of the period, before we actually get to financial statements, the companies usually do another internal document before getting to financial statements, just to double check that the debits equal the credits. So this part today, at the end of the class, we'll also be getting to trial balance. So this part here doesn't capture the detailed record. Detailed record are captured in journal and ledger. After we summarize a certain period of time of activities, the balance will be represented in trial balance, this internal document. Okay, so this is a summary of T account's final balance at the end. So this is a general accounting process. Okay, after doing this, after double checking that the debits equal credits, then the company can use trial balance information to finally do an official set of financial statements. Okay, so last week before we ended class, we talked about the debits and credits of different accounts. Remember that debit just represents the left side, credit just represents the right side. So whether or not debit of account represents increase depends on different types of accounts. Okay, so let's just do a brief summary of what we talked about at the end of last class. Assets, remember it's the left-hand side of the equation. When we apply debit and credit left and right to asset account, we always capture the information that increases assets on the left-hand side, under the debit side. Okay, so meaning that if we have cash T account, for example, we performed a type of service, provided goods to customer, collected cash immediately, let's say $1,000, this increased cash in the corporation, in the business, representing this information under the debit side. Okay, so whenever you look at T accounts, the debit side, the numbers there represents the cash that corporation collected from customer or from clients. Right? Now the credit side, whenever a company actually purchased other assets for the purpose of business operations, they purchased supplies, purchased a piece of land, building, different types of assets, using up their cash, will be representing this information on the credit side. Okay, so credit deducts asset, debit increases assets value. This is the left-hand side of the equation. And now if we look at the right-hand side, we have liabilities, we have equities. Liability has the opposite debit-credit rule compared to asset. So whenever a company borrows money, for example, if they borrow $2,000, this will be recorded on the right side of T account. So whenever there's liability that happened, that incurred in the business, we'll be capturing this on the right side, the credit side. So debit side here represents deducting liability. So meaning after a certain period of time, if companies finally have the fund to pay off the money and the due date is coming up, let's say they paid off $1,000, then this $1,000 would be recorded on the left side of liability when you pay back the money. When you increase liability, when you borrow money, it's on the right side of liability account. When you pay it off, it's on the left side. Okay, so liability account has the opposite rule compared to asset account. Now, equity part is a little bit trickier compared to asset and liability. Okay, equity, remember that there's different elements of equity. The main two parts here, we have the fund that we raise from the public, the company raised from the public, called common stock. So whenever there's fund raised, whenever a company issues common stock, obviously this increases their capital, so this boosts up stockholders' equity, boosts up net worth of the business. We'll be crediting this account. Okay, so stockholders' equity for most of the accounts, it follows the same rule as liability. Whenever we have increase in the net worth of the business by issuing common stock, by generating revenue based on providing service, providing goods to customer, when we increase the account, we credit it. Okay, but there's two exceptions here because remember, stockholders' equity also incorporates elements, dividends, when you give away cash to shareholders, or expenses. When you pay off certain, for example, rent expense, when you pay off advertising expense, salary expense related to the people that you hire. These expenses that are necessary to support company getting revenue, these are the things that reduces stockholders' equity. Okay, so whenever you had increased expenses, in reality, it actually decreases equity. Okay, so the left-hand side of equity account, later on when we have different types of expense, you open up expense T account, dividends T accounts. So whenever you have expenses accumulated, expenses will be posted here. Whenever you have dividends given away to shareholders, it will be posted on the left side just because it reduces stockholders' equity. Okay, so you can think of these two accounts as the exception of stockholders' equity. For the most part, when you gain revenue, when you issue common stock, retained earnings account, normal balance is the right side, the credit side, because this increases net worth of the business. Expenses, dividends are exceptions. Whenever you have increase in expenses, you give away dividends. These two, by nature of the accounts, reduces net worth of the stockholders' equity, reduces net worth of the business, so we post it under debit side. Okay, so this is a summary of the debit credit rule. Again, the most important thing you have to know is that debit credit just represents left and right. Whether it represents increase or decrease of certain accounts depends on account type. So asset increase, the shortcut to memorize this, try to mirror this with the accounting equation. Okay, you can just decide to memorize all the plus side so that you know the flip side will be minus. So for all the plus side, assets is on the left-hand side of the equation. All the increases will be on the left side, debit side. For right side of the equation, liabilities and equity, whenever we incur liabilities, we increase liability, increase the money that we owe to other party. We put it on the right side because it's on the right-hand side. Equity, whenever it increases, corporation's net worth increases by revenue, by raising capital from the public. Also, because it's on the right side of the equation, we post it under the right side. Okay, so the left side of the equation increases on the left, debit side. Right side of the equation increases on the right side for liabilities and equities, credit side. Okay, so this slide basically summarizes the complete debit credit rules for pretty much all the accounts that you will need for the first few chapters. Okay, assets, again, debit side increase, plus side is on the left side. Liabilities increase on the right side. Stockholders' equity for common stock, retained earnings, revenues, the first three T accounts. When we increase it, it's on the credit side. Okay, expenses, dividends, by nature, these two accounts reduce net worth of the business. You're paying off money to either pay the rent, you're paying off advertising expenses, you're paying off salary expenses, so this reduces corporation's capital. So whenever there's expenses incurred, stockholders' equity account will be reduced, so we post it under the left side. Dividends, similar to expenses. You're giving away a portion of your capital because you earned profit this season. You're giving it as a gift to shareholders, to investors. Again, reduces stockholders' equity, so we post this on the left. Okay, so make sure that you know these two are opposites compared to common stock, retained earnings, and revenues, just because it uses up capital. questions so far on the rules? Now, these debit and credit rule will be very important to know when we get to journal capturing business activities in the journal ledger, in a ledger, because we need to know which side to put which account. So when you provide service to customers, like cash, you first need to identify this activity. You need to identify the two accounts affected, cash, service revenue. Then you need to decide whether these accounts are being increased or decreased by its value. So if we collect cash, cash is increasing asset account. We'll be posting the dollar amount under the left side. Service revenue, we collected. We also increase service revenue. We'll be posting things on the right side. So whenever a transaction occurs, whenever a business activity occurs, you have to identify the at least two accounts affected. It could be more. At least two accounts affected, and then decide whether it increases or decreases the account. Record it based on debit credit rule. So always, regardless of the accounts affected, always the debit side of the amount would equal the credit side. So this will make the accounting equation balance. Okay, we'll get to a few examples today in the exercises, so you get a feeling of how to actually use these debit credit rule and tie it to the accounts, tie it to business activities. Okay, now another idea here, normal balance, this term, this simply represents the plus side of each account. That's all it is. Okay, so whenever a problem refers to what is the normal balance side of a certain account, just think of the plus side of that account. So for asset account, is it debit? Is debit the normal balance or credit the normal balance? It'll be debit, right? What about revenue? Revenue is a stockholders' equity account, and the plus side would be the credit side. Okay, so revenue account's normal balance would be the right side. Okay, normal balance, this term is just referring to the plus side of the equation. And the reason why we need to know this is because before we get to trial balance, remember this is a summary of all the accounts, we'll be summarizing a bunch of T accounts after many transactions happens, summarize the balance and put the balance on the normal balance side. So meaning that if, let's say, cash account, there's one transaction affected here, there's another $500 transaction affected under cash account, there's another $3,000 affected, all on the plus side. And let's say the right side, we also have a $500. We use up a portion of the cash. At the end of the month, if this is the only 4 transactions that happened in this month, we'll be summarizing this by drawing a line, adding up the left side, debit side, minus the right side, and the balance will be put under the normal balance side, which is the plus side of that account. Okay, so meaning after a month of transaction, let's say there's only 4 transactions, then cash balance you would see $4,000 balance underlined, summarized as cash account, and representing on the plus side of the equation, of the T account. Okay, so another example for liability. If these are the only 2 transactions that happened, then at the end of this month, we will see $1,000 listed under the normal balance side of liability, which again is the plus side of liability, credit side. So you'll be using this side minus the other side to figure out the balance. For equity, same thing. For revenues, for common stock, you'll be adding up the right side and then summarize the balance on the right side of the equation, right side of the T account, because this is the normal balance side of that account. Okay, so again, normal balance just represents the plus side of the equation. At the end, before we get to trial balance, we'll be looking at each and every account's normal balance side and just copy that dollar amount to trial balance. It's a summary of all the different T accounts. You will see normal balance side representing the summarized information. Okay, so again, for assets, for expenses, for dividends, it's the left side of the equation where we will summarize the information. Will be posted on the left side, debit side, for assets, expenses, and dividends. Okay, liabilities, common stock, retained earnings, revenues, all of these accounts, the normal balance is on the right side, the side where the account increases. Okay, so at the end, we'll be summarizing dollar amount after a certain period of time listed under the right side. Some of the slides I'll be posting a little bit later. There's a student version of the slides typically has some of the portions out. So I would expect you to have the slides and put down the main points on the student version of the slides. But before midterms, I'll be giving you the slides with the exercise answers. Yes, okay? But keep in mind, all the slides information is no different from textbook. Everything here is exactly from the book. Okay, so textbook is definitely the thing that you have to review every single week. It's more comprehensive. All right, slides, student version or the version that I have, both of them do not have the exact same information as, it's not as thorough as the textbook. Okay, so make really sure that you read each and every chapter in the book. Slides is just something to support you. All right, but I'll definitely post the ones with the answers, exercise answers, before midterms. All right, let's move on. So basically, to summarize the first part of the chapter, what we've been trying to do is that to guide you through the accounting process in general. We'll be starting from a business activity that happened. Later, we'll be going into some of the examples together. So for each and every transaction, we will have some sort of source document. So in the real world, you will have bank deposits, you'll have purchase invoices, sales invoices, checks that has the other party, whichever party is the corporation is paying money to. So those source documents, you'll be able to identify the party's name that you're dealing with, the dollar amount, the date. Those are the documents that backs up these transactions. So from those transactions, accountants will be able to identify what are the account names, accounts basically, that are affected. Then we apply debit credit rule along with to determine whether the account is being increased or decreased by the value. Okay, so once identifying accounts, identifying the side of increase and decrease, we'll be recording transactions in journals, and then we'll be posting them to T accounts. And at the end, get to trial balance. The final step will be getting to the financial statements to disclose to the public. Okay, so this is a general cycle that goes on and on based on daily business transactions, based on the source documents that accountants are able to access. So these are the documents that backs up these activities, and they will use those to identify the accounts affected, the dollar amount, the side of which account increases and decreases, capture these in journal entry, post them to T accounts, generate statements. Okay, so this is a general flow of accounting data. How does it work from journal to ledger to financial statements? Okay, let's do a brief exercise. Stop a little bit before we get into detailed examples of journalizing and posting. Step back a little. You can refer to the information on the whiteboard. Let's go over this together. So when are the debits increases? What types of accounts represents that the debit side is an increase in value? Cash account, which is part of the asset category. So all of the assets category, we have debit increase. What else? We have stockholders' equity, and there are two exceptions here. Right? So stockholders' equity, for the most part, increases on the right side, but we have two exceptions, expenses and dividends. Whenever we have these dollar amount accumulated, we'll be posting these on the left side, debit side as well. Okay, so for this category here, asset is being increased on the debit side. Dividends, when you give away to shareholders, we also record this on the debit side. Expenses, also the debit side. Okay, so the opposite question here, what are the accounts that you will see debit side is representing decreasing in value? Basically all the other ones that we haven't mentioned in number one, right? So All the other accounts, the debit side decreases in liabilities, debit side decreases for common stock, for revenues, stockholders' equity in general. But for the most part, you would not see revenues being decreased. Okay, this usually is the case when there is some sort of error in capturing this transaction. Otherwise, for the most part, whenever we raise capital from the public, generate revenue based on providing service and goods to customer, all of these information will be recorded on the credit side of revenue and common stock. So very rarely would it be posted on the debit side. So that simply only represents the transactions that had an error mistakenly recorded. Then you'll be fixing the problem by debiting it. Otherwise, for the most part, credit side would increase for revenues, for retained earnings, for stockholders' equity, and issuing common stock as well. Usually is on the right side. Now, credit side decreases. This is the opposite. This is the opposite of the first question. So, debit side increases for asset, expenses, dividends. The opposite question would be credit side decreases for those accounts as well. Any questions? Okay, the third section of the book, we go into some of the examples of actually journalizing and posting these to ledgers. So again, this slide summarizes the process, which we actually talked about already earlier. We identify each and every business transaction's accounts that are being affected, determine whether those accounts are being increased or decreased in value, and then record transaction in journals. Okay, so in the middle part, when we identify whether the accounts are being increased or decreased, remember like the problem that we had last week in one of the assignment problems, the plus side of increase or decrease in certain accounts. Now we add in debit credit rule before we get into journal entries. Okay, so it'll be recording, let's say, the increased side of assets on the debit side, increased side of liability on the credit side. Okay, so debits and credits rule will be tying that to the accounts increase and decrease that we did earlier in Chapter 1. Now, whenever we record journal entries, the transactions, business activities, and journals, we always record debit side first. Okay, journal entries, there are a few lines. Later I'll be showing examples. We always, after you identify the two accounts affected, once you identify which side will be on which account you'll be recording things on the debit side, that will be the one that appears in the first line. Okay, so debit side of the entry is always recorded first, and then we capture credits. Just something in accounting, we always do debit side first, then credit. Let's take a look at this example. If we journalize this transaction here, the company received $30,000 in cash by raising common stock, meaning that shareholders contributed $30,000 to the corporation. This is not a money internally generated. This is externally generated from the public. So this transaction here at the same time affects cash account and common stock account. So which account will we be recording the dollar amount under debit, and which account will we be recording dollar amount on credit? Cash is the asset account, and we have increase in cash, $30,000. So meaning that $30,000, you would see it under the plus side of assets, which is the left side. Okay, common stock is the other account affected. Common stock, the rule here for stockholders' equity, whenever we increase net worth of the business, it will be captured on the right side. Okay, so for this particular transaction, raising capital from the public always affects cash and common stock. Cash account is being increased, common stock is also being increased. Both are on different side of the accounting equation, and when cash is being increased, it will be debited. So we capture cash first. Remember, always record debit first. Then we capture common stock and the dollar amount, $30,000. Okay, so this is an example of one entry, raising capital from the public, affects cash account, asset increase, affects equity account, equity increase. Both increases by $30,000, and we record debit side increase first, then the credit side. Okay, and each and every transaction will be organized by date, April 1st. So this is one example. Take a look at another one. The detailed parts of the journal entries here, before we get to the second example, the detailed parts here will be capturing, again, the date of the journal of each and every transaction. Remember, a journal is organized by date, and then the two accounts affected determine which one increases debit, which one increases credit. Debit side is recorded first, then credit. Okay, dollar amount will be posting under the debit side and credit side, respectively. Then in the last part here, typically there will be an explanation of this journal entry. Okay, so some of the homework problems you may be able to, on my lab there's usually a drop-down box for you to select from. So you will see a lot of the options available. Just choose the one that represents this journal transaction. So this will basically have very similar terms or wordings in the first line of the original question. So the original question will be journalizing transactions on the receipt of cash and issuance of common stock. Here you have the explanation, simply a narrative of that issued stock. Okay, so this is just a more detailed explanation of what is going on in this particular business activity. Okay, so there are four parts here: the dates, the accounts, the dollar amount, and typically at the end we will have a description of this transaction. Okay, once again, the date, the accounts affected, the dollar amount, and a brief explanation of this transaction. These are the four main parts for each and every journal entry when we're capturing this activity in the corporation's accounting book. And let's go over a few of these. I'll give you a few seconds to think about these four transactions and we'll go over it together. Okay, so you see January 1st, you have one transaction happen. January 2nd, you have two of them. January 3rd, we have another one. Try to go over these quickly, a few seconds, and see if you can identify the accounts affected and possibly link this to debit side and credit side. Okay, I'll give you a few seconds to think about this. All right, January 1st, first transaction here is really pretty much exactly the same as what I just covered, the example, except that the dollar amount is different. Okay, so again, the company is raising capital from the public by $29,000, receiving cash, and this at the same time affects equity account, specifically stockholders' equity, a common stock account. So we have cash account affected, we We will have an increase in cash, and remember, increase in cash account is an asset account, so we have the debit side increased. So we'll be recording cash first, and again, then common stock. Because whenever we increase common stock is on the credit side. Okay, dollar amount is $29,000. Description here, issuing common stock. Issue stock. The next one here, purchase medical supplies on account for $14,000. So what are the two accounts affected here? You see the term on account, and now the corporation is the party buying things from others. So that on account will represent which account? Exactly, very good. So we will have supplies being purchased. Supplies is a type of asset, and this will increase supplies value by $14,000, so we'll be debiting this account. At the same time, on account here represents accounts payable, because the company is now the party purchasing things but not paying the money immediately at this moment. Okay, so this account here will be affected. On account represents accounts payable instead of accounts receivable, because the corporation now is the party purchasing items from others. Okay, so on accounts represents the dollar amount, $14,000, that they are not yet paying by cash. The promise of payment later, typically within a month. Right, so we have medical supplies account affected, accounts payable affected. One is an asset account, one is a liability account. Okay, asset account increases debit side, liability increases credit side. Description here, purchase supplies on account. Just explaining this business activity. The next one here, January 2nd, we have paid, the company paid off monthly office rent of $2,600. So paid something immediately, paid $26,000, and specifically they're paying for rent. So what are the two accounts affected? Want to try? Credit cash by $2,600, and debit rent. Rent represents rent expense. Rent expense increase will be recorded on the debit side. So we'll be capturing, thank you, very good. We'll be capturing rent expense on the debit side of the journal entry. Cash, since we're using up our cash now, we're paying off the money. This reduces cash account. We're recording this under credit side. The dollar amount for both of these, $2,600. This represents paying office rent on this date. Okay, so we're using up our cash, and specifically using it for paying rentals. So we have rent expense affected. Rent expense, remember, expense account is a special account under equity. So whenever it increases, the nature of this account reduces stockholders' equity. So we'll be recording this under the debit side. Okay, using cash, record this under our credit side, reducing cash account. Okay, moving on. Last one here, we record $8,000 revenue for service rendered to patients on account. So we provided services to customer. It could be any type of service, depends on the business. We recorded $8,000 of service revenue, and this service is provided on account. So what does this on account here represent? And revenue $8,000. So which one will be recorded first? Accounts receivable will be debited, so it will be recorded first. Yes. So we have this transaction here. Accounts receivable is affected because this is a type of revenue that we're receiving from customer and is a promise from customer to us that they will be paying us later. So it's a cash receipt later on. We'll put this under accounts receivable account. Again, it's a part of asset, so we will be debiting this account. Service revenue, part of equity account. Regular balance for revenue is on the right side, credit side. Credit increase, so we'll be posting $8,000 on the credit side for this. Okay, so we're providing service, we're providing goods to customers, and not yet collecting cash. So this is a type of benefit that we'll be receiving later. Cash received later, it's under asset account, accounts receivable. So accounts receivable increase, we'll be capturing this on the debit side, revenue on the credit side. Okay, any questions on these transactions so far? Capturing in journals? Keep these numbers, we'll be using these numbers again to do the exercise of ledger, posting it to T accounts. Okay, but let's go over some of the examples first. So here again, if we have a journal entry and we want to copy and paste the exact same information in another form in the accounting book, in the ledger, then we'll be opening up T accounts. These are T accounts will represent the journal entry accounts, the accounts that you'll see in journal entries and the accounts that are affected. So this particular entry, again, raising capital from the public, affects cash account and common stock account. So you'll see two T accounts open up, one for asset, one for equity. And we just simply copy and paste the left side of that account to the left side of the T-shaped account. Right side, credit side, to the credit side of that account. Okay, so that's really all it is. We identify journal entries, the accounts affected, and just copy and paste the same information to the T accounts that we opened up. So these two are opened up because these two are affected, and the debit side will capture the debit side of the journal entry that is affected, cash increase. Common stock side will be recording under the right side because this increases common stock account, so we capture it under the credit side. Okay, if you have follow-up entries that also affects cash account, we'll be just adding the dollar amount to this cash T-shaped account. Okay, so we just have one T-shaped account open up for one type of account. You won't see multiple common stock or multiple cash. Once you open up an account, the other transactions that affects this account, you'll be just capturing them in the same T account. Okay, so if we have this journal entry here, we'll be opening up cash T account, common stock T account, posting the debit side to the left side, credit side to the right side. Okay, if we have an additional entry, so what does this entry mean? The second one here. Entry. That's good. So this is how we post it. But what does it mean for this entry? What is represented here? What does this activity represent? Meaning, are we gaining the cash or are we giving away the cash? We're giving away the cash in exchange for a piece of land that's worth $20,000. And both of these accounts are under asset category. There are two different accounts of assets. One account is being increased by the piece of land, the value of the land, $20,000. Cash account will be reducing this because we're using up to purchase that piece of land. Changing a type of asset for another type of asset. Okay, so you see cash account capturing the transactions we had earlier. Common stock, we increased cash $30,000, and now we're reducing cash by $20,000. Okay, so when you look at the T account over there under cash, if I don't tell you what has been going on in the journal entries, when you look at that, you should be able to identify that the left side represents earlier we received, the corporation received $30,000. The right side represents later on the corporation paid out $20,000 in exchange for something. Okay, so when you look at each and every T account, you should be able to identify Land, we purchase land that worth $20,000. Common stock, we issue common stock and we raise capital from the public by $30,000. So without giving you these journal entries, when you look at the accounts, you should know what it represents. Whether it has been increased, the account has been increased or decreased. Okay, so if we draw a line there for cash, remember the idea of normal balance. Cash is an asset account. Normal balances will be on the left side, where the side where the account is being increased. So if these are the only two entries that happen in this month, and we want to summarize that account, we'll be drawing a line there and capturing the left side of the amount minus the right side. So the balance here for cash is $10,000, and we'll be posting this, representing this $10,000 under the normal balance side, which is the left side for cash account. Okay, so for common stock account, it will be the right side, because that's the side where the normal balance is. For liability account, also the right side. Okay, another example here. You see office supplies, you see accounts payable. What does this mean? We owe money, $500, specifically because we purchased office supplies, but we have not yet paid cash. So we have accounts payable liability. But at the same time, we have increased assets value $500. So since both of these are new accounts, we'll be opening up two new T accounts, post the office supplies value to the left side because it's an asset account. Asset increases on the debit side. Accounts payable, the right side. For liability, the increasing side is the credit side. Okay, so this journal entry represents corporation purchasing supplies on account, meaning they're not paying cash, so they have money owed to third party by $500. Okay, another one. You see cash, you see service revenue. So what does this transaction mean? So the corporation is gaining money or losing money? Gaining money because they provided a certain type of service to customer that worth $55,000. Okay, so you have again cash account affected, increasing cash, post this dollar amount to the left side, debit side. Revenue, the balance, normal balance is the right side, the balance where the account increases. The side where the account increases, so revenue will be posted under the right side, credit side. Okay, so this is an example of after multiple transaction happens, what a ledger would look like. We just went over about 4 transactions, post them, journalize them in the journal, and post them to T accounts. But after multiple transactions, it should look something like this. So you see the left side is a bunch of asset accounts. How many asset accounts can you see here? Assets. Cash, accounts receivables, office supplies, land. Okay, so we have 4 assets account, left side of the equation. What about liability? Only 1, accounts payable. Equity, we have a lot of them, right? As long as you have a certain type of expense, you will open up separate accounts for different types of expenses. So you would see utility expense, salary expense, rent expense, and different types of rent expense. Service revenue, the only revenue account you see here. Externally generated capital, common stock, $30,000. And there's also dividends. Okay, so you can see that dividends, the balance is on the left side. Remember, dividends and expenses are exceptions in stockholders' equity. Reduces stockholders' equity account. So whenever these transaction happens, it's always captured on the left side. Revenue, common stock, you see under the right side, credit side. So that revenue account there represents that April 8th, we provided services to customer, collected $5,500. We may not necessarily be collecting it by cash, it will be generated revenue that represents $55,000. It can also be accounts receivable. April 10th, we have revenue generated $3,000. Altogether, the balance is on the right side, the normal balance side, $8,500. Now, if we take a look at that liability account, what does that represent? Meaning that $300, what does that mean? We still owe $300 after April. Okay, and specifically, if you dig into the transactions, you see the right side, April 3rd, $500, April 30th, $100. So that means, since the right side is increased, that means earlier we had liability, either borrow money from others or purchase something that we have not yet paid. Altogether, it's $500 and $100. Then the left side, April 21st, we paid off a portion, $300. But at the end, we still have $300 that we owe to other parties. Yes? Okay. Right, so liabilities, the right side represents the money that you owe to others before. Left side represents the part that you paid off. So overall, you still have $300 that corporation owes to other party. Now, cash account here, you see multiple transactions. There are 8 of them that has affected cash account. So the left side represents what? Debit side, and specifically debit for assets represents the money that corporation actually received. Right, so left side, they received April 1st, $30,000, then $5,500, $2,000, $9,000. What about the right side? The money that they used. Okay, so there's also 4 of the transactions that affected cash account. Specifically, they used up a part of the cash. But overall, the balance, remember the net normal balance side for cash is the left side. You see the balance, $2,100, and that represents the net effect of all these transactions. So at the end, the company still owns $21,000 of cash. This is the total balance. 300? So the right side is the money that you borrowed or owe, right? Either by purchasing something, not paying the money, or you borrowed. Let's say you borrow $500, you owe $100 based on purchasing supplies. Altogether, you owe $600. But in the middle of the month, 21st, you paid off $300. So the left side captures the money that you no longer owe to other parties. You actually already cleared it. You cleared only a portion, not the whole. So you clear $300, and at the end you still owe $300. $600 minus $300. Okay? So if you see a balance under liabilities, that always represents the money that you still owe to other parties. If the company do not owe any money, you will see balance as 0. Okay, but as long as the credit side exceeds the debit side, then that means you have not yet paid off the money, the total amount of money that the corporation owed. Okay, so we still owe $300. Cash, we have $21,000. Accounts receivable, what does that mean? That $1,000 represents the balance, which means that this is still the money that corporation will be receiving from customer later. Okay, so accounts receivable here, you see April 10th, $3,000, meaning this was the money originally customer promised to pay you later. Then April 22nd, you actually do have a few customers that paid you back the money. Okay, so that would be $2,000, but still not the whole thing. So you still have remaining $1,000 that you will be collecting later. Okay, so $3,000 was a promise from customer to pay the money based on either the goods or the services that you provided. It may not be just from one customer. It could be from multiple ones. So the right side here, April 22nd, a few weeks later, then you see part of the customer is paying back the money. And then you still have a balance of $1,000 representing the customer that have not yet paid you the money based on the service and goods that you provided to them. Okay, so the balance represents future cash receipt. Okay, questions so far? Now, supplies simply represents the value of the supplies that is still in the corporation. Land, you see land, the debit side is $20,000, representing increase, meaning you have a piece of land that you purchased that's worth $20,000. What about the right side? possibly that the company sold out other pieces of their assets, other pieces of land that are only worth $9,000. So these could be separate different types of assets, but it's all part of land account. So you had a piece of land that you purchased that worth $20,000. You sold out a part that worth $9,000. Overall, the property in total worth $11,000 after this month. Okay, so two transactions that related to property's value. Okay, so here are a bunch of T accounts. If after a month you have summarized all the transactions, then the balance amount you see here are basically ready for trial balance. So what trial balance is, we're just picking the balance and represent it under an internal document called trial balance. So under trial balance, you would not see the detailed changes, detailed transaction amount. You will just see the balance for each and every account. That's all. Okay, so the purpose of capturing these in ledgers, at the end, we want to summarize each and every account's changes after adding, subtracting multiple transactions. Then you just use the balance amount and copy that balance to trial balance. Okay, before we get to trial balance, let's try to do the posting. I'll show you a few examples of posting these transactions again. So these are the journal entries that we did a little bit earlier. Remember, we have 4 of these. If we want to post these to T accounts, it will look like this. We have cash affected, common stock affected. Again, you open up 2 accounts, post the debit side to cash debit side, credit side to common stock credit side. Okay, so again, journal entry and ledger really is the same information, just a different format. Okay, for medical supplies, accounts payable. So one of them is asset account, one of them is liability account. Okay, this was an entry that we did earlier. We want to represent this under T account form, the ledger. You have 2 accounts open up. Debit goes to the debit side of asset account, credit goes to liability increase. So we purchase supplies and we not yet paid it by cash. This affects asset account and affects liability account. Liability increase posted under the credit side.
Is this only working through cash, or is it like also credit cards? Am I using this?
Credit card would be the idea of accounts payable for part of these. We'll be getting into that in Chapter 8. So yes, this also represents all the transactions that relates to dollar amount, monetary terms. So yes, incorporates cash, credit cards, checks, other types of contracts that you promise, notes, all of these falls under it. Accounting will be capture all of those transactions. Okay, where was I? We're going into the next transaction here. If we paid off cash, specifically paying for rent, we have an expense account open up. Cash account will be just using the one that we had earlier. Post the rent expense dollar amount and the cash that we use up to the credit side. Okay, accounts receivable, service revenue. So we have assets increase on the debit side, we have revenue increase on the credit side. Again, open up 2 accounts. Debit amount goes to debit side, credit amount goes to credit side. All right, if we take a look at all the accounts that we just used for these 4 transactions, we will have 7 accounts open up here. And specifically assets, we have cash, we have accounts receivables, medical supplies. Liability, there's accounts payable, one of the transactions that we promised to pay parties later. Equity, there's common stock, raised capital from the public, that transaction, the first one. We have service revenue and rent expense. So if we were to summarize just these 4 transactions, then the balance, again, we'll be posting it, summarizing the balance on the normal balance side for each and every account. So for assets, normal balance is the plus side, remember the debit side. Accounts payable, liability will be the credit side. Common stock, equity account, normally is also the right side. Expense and dividends are on the left side. Okay, so this is an example of getting to a trial balance with only 4 transactions. If we were to summarize ledger and figuring out the balance for each and every T account, it will look like this. And we will only be using the black highlighted numbers for trial balance. Okay, now trial balance, again, is an internal document. It's not disclosed to the public. It's just for the purpose of supporting getting to financial statements. So we'll be summarizing this information based on the sequence of accounting equation as well. So we would start from assets, then list liability, then list equity. So really, pretty much it's the same sequence as how we write accounting equation. So let's take a look at trial balance examples. Again, as I mentioned earlier, the sequence here, we start from assets, then we list liabilities balance, then we list equities balance. At the end, what we want to make sure is that the debit column equal the credit column. We want to make sure that earlier, during the process of posting things from journal to ledger, from ledger to trial balance, everything has been posted on the right side. So meaning if at the end, doing one of the trial balance sheet, you figure out the debit side do not equal the credit side, then that means something is wrong before. So you have to go back to check some of the transactions, and later at the end of this chapter, I'll be showing you some of the shortcuts, how you can get to some of the transactions that possibly went wrong before. Okay, so trial balance again, you have to know this is an internal document. This is not the same as balance sheet. So even though it captures pretty much almost the whole set of information, but it's not disclosed to the public, it's just internal for internal usage purposes. Okay, let's take a look at a trial balance example. So here's a trial balance for April 30th. Pretty much summarizes all the transactions that happens in April, this entire month. We would start from listing all of the asset accounts. Okay, you see cash, accounts receivable, office supplies, land. And then you have liability account and equity account. And then equity is specific, usually we just listed based on the sequence as we discussed the accounting equation, the equity elements. We start from externally generated fund, then there's dividends, service revenue, and all the expenses. Okay, we start from externally generated fund, and then later on the accounts for internally generated revenues, and also the expenses that the company used up. Okay, so this is just a general sequence. Now in terms of the detailed account sequence, you don't have to worry about that. Okay, so in this week's homework, you will have an example of doing, a problem of doing trial balance. Just make sure that you group all the assets in the beginning section, middle part liability, later part equity. Okay, now you see the debit and credit column there. Now remember, all the assets will be under, you will see the balances under the debit side, because these are the information that we copied from ledger to trial balance. So remember, all the assets, normal balance is on the left side, so you see all the assets value under debit column. But for accounts payable, the opposite. Normal balance on the credit side, so you see the balance under the credit column. Common stock, equity account again. Equity account, whenever it increases, is on the credit side. So you see common stock, credit side. Dividends, and all the expenses are exceptions. So when we have these incurs, it's we will post it under the debit side. It reduces stockholders' equity's value. Revenue, just like common stock, retained earnings, normal balance is the right side. Okay, so again, the purpose of doing all this, at the end, we want to make sure that these two, debit column balance and credit column balance, equal to each other. Okay, this is the goal here. The goal for doing the internal document, trial balance, is to make sure that debit and credit equal to each other. If these two do not agree with each other, then we have to go back to ledger to double check some of the transactions, whether we have been posting it to the right side. Okay, so if we go back to this example here, if we were to list the trial balance, well, actually find a piece of paper, try to list the trial balance and see what is the total debits and total credits. So based on these black balances here for each and every T account, try to figure out the balance of debits, the total debits, and the final summary number of total credits and see if they are the same. Okay, anybody figure out the balance for debits and credits? 51,000. Other answers? 53,600 for both sides, debits and credits. All right, let's go over this together. So where do we start from? If we were to do a trial balance, what are the first few accounts that we'll be listing? Start from cash, accounts receivable, medical supplies, and all of these are under the debit side. Right, so you have 26,400, you'll have $8,000, I'm just omitting the accounts here, and you will have $14,000 here. Okay, now the next one would be which account? We will have accounts payable, $14,000. Will be under the credit side because liabilities normal balance is the credit side. Okay, now what about the other ones? You have common stock under the credit side. We have $29,000. Service revenue. Revenue is an equity account. Normal balance is increasing on the right side. We also have $8,000 on the right side, credit side. There's rent expense. Opposite rule compared to revenues. So it will be under 5. Okay, so basically you'll be adding up the left side of the amount to the right side. it will give you at the end $51,000 on the left side and $51,000 under the right side. Okay, so you'll be adding these $3 amount, the assets categories, with also rent expense. The right side, credit side, you have common stock, you have revenue, also liability account, $14,000. Yes.
So the trial balance is the final balance, right? Is that for the cash?
Mm-hmm.
I just wrote it separately. I didn't put the balance. I did it separately. That's what I did.
Oh. For trial balance, just by the term of this internal document, we'll be only using the balance. So meaning all the all the black numbers here. Okay, so just the balance for each and every account. We'll not be capturing the detailed changes for each account. Okay, because we're trying to get to financial statements, which should be a summary of all the transactions. So these examples are fairly simple because there's only a few transactions. But in reality, daily transactions in a corporation could be hundreds and thousands. Right? So, and then if you add up an entire month or entire quarter, that's even more than that. Right? So these information is just a summary of multiple transactions. At the end, the balance for each and every account. Right? So the whole purpose of trial balance is to make sure left equals right at the end. Now, some of the exceptions here, and in case you find the left do not equal the right, so there are some of the shortcuts here that may be able to help you to trace back some of the transactions, which ones are really the ones that has problems, which ones that you actually mistakenly posted the right number to the other side. Okay, so specifically the second and the third would be the ones that we consider as shortcuts. So here's an example. Let's say the company generated cash, received cash based on providing service revenue to customer, and for example, it's worth $500. So for this transaction here, we'll be debiting cash because we're receiving cash. We'll be crediting service revenue. This is the correct case. And if we post this to T accounts, let's say earlier we mistakenly posted this $500 to the credit side, and we also posted service revenue $500 under the credit side. So at the end, when we summarize all the information, you will see under trial balance, if this is the only transaction that happens, for simplicity purposes, let's say this is the only transaction that occurred, then you see under trial balance, the left side there's nothing, the right side there's two 500s. So at the end, this will affect final balance to have a difference that is actually the double of this error amount. So the difference is here, 1,000 minus 0 gives you $1,000. This is the total balance difference between debits and credits. If you divide this dollar amount by 2, this will give you 500, which is exactly the dollar amount of the transaction that there is error. And specifically, the error is misposting it to the other side. So where it should have been debit, but you posted it under credit, or the opposite, if it should have been credit, you posted it to debit, the error effect will double. Okay, so at the end of trial balance, if you see the differences, and if you try to divide it by 2 and it gives you a dollar amount that's evenly divisible, then it's likely that there is an error occurred based on posting the numbers to the wrong side. Okay, so this is one shortcut. You can try to divide it by 2, and then the number that you get, the $500, or whichever number that you get, will likely be the transaction that has error. So you can narrow down all the transactions in the past that relates to $500. So trace back those first. Now another type of error would be, let's say, a slide error or a transposition error. So that could be adding an additional 0 or missing a 0. Okay, so if a transaction is supposed to be $1,000, again for cash, and service revenue, you have also $1,000. And when you post this transaction, when you recorded it, you actually missed a 0 for cash. Assuming everything else is correct, then at the end you will have a balance. Left-hand side is 100, right-hand side is 1,000. The differences here is how much? 100 on the left, 1,000 on the right. You will have a difference, $900, and this $900 will be evenly divisible by 9. After you divide it by 9, you will get 100, which would be the transaction, the error transaction, you will see $100 there. But this evenly divisible by 9 can either be that, having an additional 0 or missing a 0, or it could also be some of the transactions that you switch the digits. So for example, if you have recorded $1,200 of cash, but you mistakenly recorded as $2,100, you see the differences in between. The 900 is also evenly divisible by 9. Okay, so if you find trial balance, the ending balance is evenly divisible by 9. The difference is, it could be either one of these. But these are harder to trace compared to the type of error that you just posted to the wrong side. Because for switching digits, after you divide it by 9, the number really doesn't tell you anything. But after the fact, if you actually trace the transactions, you will realize that some of the digits you switched it. Okay, but a shortcut for a slide error, adding a 0 or missing a 0, if you divide it by 9, that will tell you the error number that you got. Okay, so these are some of the shortcuts. To be honest, the most thorough way to find a transaction error will still be the first one. Tracing back to all the ledgers, making sure each and every one of them is posted to trial balance correctly, or is posted from journal entry to ledger correctly. Okay. Nowadays, typically the accounting information systems will be able to help you when you journalize entry. Usually it's automatically creating the ledger. So if you post something to same side, 2 of the accounts to debit side or 2 of the accounts to credit side, usually the application will not allow you to do so. Okay, but at the end, if you still have these transactions, if it's for small businesses that you're not really using the applications, you will still have these types of errors. Posting the numbers to the wrong side, or simply another type of error will be using the wrong accounts. So those are even harder to trace. Okay, if you use the wrong account, it should have been sales revenue, but you posted under service revenue. But from trial balance, you can't detect this because the number are both under the credit side. So that would be an example that based on these shortcuts, you're still not able to detect. Really the most important thing is from the beginning. When you start from journal, post it to ledger, calculate all the information, the balance to trial balance, that has to be done very thoroughly and very much in a lot of details. Okay, any questions? So today the key takeaway is that you have to know again the debits credits rule. How does that apply to transactions? You need to figure out for each and every business activity, ask yourself, what are the accounts affected? Okay, now in this week's homework, there are just a few transactions that you may be able to see more than 2 accounts affected. So you see based on the description, for example, corporation paid cash $1,000 to pay off rent expense $500, advertising expense $500, other types of expenses. So if you see more than one account, then just list them. Again, apply the debit and credit rule. Okay, the part of the account that is increased, whether it's debit and credit, that depends on different types of accounts. So assets is always the left, liability is the right, equity is the right.